Welcome to Bar Chart series of webinars designed to educate you about a variety of market concepts, inform you of features and tools Bar Chart provides related to these concepts, and finally offer you some trader's insight to help you make a more informed investment decision. Today's subject, swing trading strategies of success. So of the three types of trading styles, day trading, swing trading, and long-term investing, swing trading is the most versatile in terms of different types of strategies that could be employed using the swing methodology. In other words, buying and selling a wide variety or range of securities, but also acting upon the information derived from swing trading to execute certain types of option strategies. So the skill of the swing methodology will be our focus today. And although I will mention when and where different types of option strategies could be engaged, our focus will be more about the methodology. So, hang on. Hello, everyone. My name is John Rowland, Bar Chart's Head of Trading and Education. And back in March, we did a swing trading session. And in that webinar, I kind of showed you how I go about selecting candidates using the bar chart features and tools for swing trades. Plus, I also talked about how to assess risk and reward and to find higher probable trades. But afterwards, I realized from you guys, our viewers, that your comments and questions that I lacked really giving you details about information and the methodology, in other words, the process. And so that's what I really want to do today. So let me start by saying that we don't need to go back and watch the first session to understand the material that's going to be presented today. As a matter of fact, I think you probably will be better off watching today's session and then going to watch the March session afterwards, all right? So that's what I kind of want to do for you guys today. But before we get to that, please welcome my partner and our moderator, Bar Charts Project Director, Gene Baker. Hello, Gene.
Good afternoon, John. Hi, everybody. How's
Good
it going?
Afternoon. It's going. It's going. It's trying to keep my head above water.
The kiddos are back to school today here in the Chicago area. It's getting to be that time. Summer's winding down.
I haven't noticed in my neighborhood. I haven't seen the school buses come around yet, so maybe we're not here yet. But yeah, that's right. This is about the time of year, isn't it?
Yeah, it is.
So make sure, folks out there, make sure you obey the speed limits in your neighborhoods, right? Kids are back out on the streets, right? So anyhow, that's our safety feature for the week, I guess. All right.
So let's get started. We've got a lot of things to talk about with swing trading. I know you've got a lot to cover today.
I do have a lot to cover. Okay,
yes.
Great. All right. So before we get started, just to remind you that today's session is for educational purposes only, and the decisions to buy, sell, or hold or trade securities, commodities, or any other investment involves risk and best made by or with the advice of a qualified financial professional, and under no circumstances shall we be liable for any loss or damage you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in, based on material or information that you receive through barchart.com and or our services. Okay. So what is swing trading? So swing trading really ideally is a short-term trading system where it's somewhere between a couple of days to a couple of weeks. And the goal or purpose is to capture a small portion of a larger or greater trend or price movement. And finally, because of this short-term nature of swing trading, we're going to rely on technical analysis. So things like trends and moving averages and pattern recognitions. Maybe you might know terms like supply and demand or support and resistance, but also assessing price movements in terms of something called average true range. And that's just a few of the examples of technical analysis that we might be using. Now, swing trading, the process, right? So the outline for today's session is basically this. First, we're going to look at selecting your market. Now, this is going to be twofold. The first being that we're going to look at those markets and we're going to figure out which ones fit our risk appetite, or better yet, eliminate those that are what we would deem be risky. And the second part of the selection process, we're going to look at a top-down process, of candidates, kind of looking at that, overall big picture of the market, then, drilling down into sectors, and then inside of the sectors, look for individual equities. We're going to do a process called multiple time frame analysis. This is in context of our price analysis. So we're going to go from high to low. We're going to look at a high, and that's going to give us our range of probability. I kind of call this my playing field. And then we're going to go to an intermediate time frame. We're going to do a trend analysis. And then we'll go to a lower time frame and use this time frame to help us to refine our risk and to help hopefully improve our potential profits. So the aforementioned trend identification, right? So that process, we'll look at that. Now, this is where it seems to be a lot of confusion among my junior traders. And when I mean junior traders, I mean just traders who are trying to acquire experience and skills. So we'll work on that today as well. Once I identify my trend and where that trend is inside of my playing field, this big picture, this is going to help us determine what type of entry we're going to employ, be it a pullback or drawback or a potential breakout. And then finally, and probably the most important aspect, is assessing risk and setting targets. We're going to look at this in terms of a ratio of risk versus reward, determining the worthiness of potential trades. In other words, yes or no, do I want to take this trade? Do I want to put capital to risk based on these outcomes? Okay, so that's kind of our guideline for today. So the first part of our process is our market selection. And like I said, first we're going to kind of look at, tradability. In other words, when I go to choose candidates to trade, I want to make sure that I'm comfortable with that particular candidate in terms of some variables. And some of the variables you could think about would be, capitalization, say market cap, the price of a particular stock. Maybe your capital that you have, you can't trade $250, $500 stocks. It's just they're too expensive. Maybe you feel more comfortable trading, $25 to $50 stocks. That's kind of your wheelhouse. But volume, we talk about volume, and a lot of times in our sessions, there's some volume has a lot of, it's multifaceted in terms of how we can use it. But one of the aspects of volume is liquidity. And what we might use in terms of selecting a particular stock or ETF would be looking at volume. The greater the volume a market has, also the greater the liquidity, the smaller the bid asks will be. In other words, it's a lot easier for us to get in and out of the market. If I'm trading a small cap stock, I'm not saying that you can't trade a small cap stock, But if I'm trading a small cap stock that has less liquidity, that bid ask might be a little bit wider. I might be correct in my analysis. I might be correct in my picking my trend, but there might not be enough liquidity for somebody to take me out of my positions, or in other words, to buy or sell to me. And again, if we think about this on the risk side, when I determined I want to get out, I decided that risk is too great. Again, that illiquidity could make it a little bit more difficult for me. So a lot of things you can think about. On just, we just talked about price and volume as a way to filter out. Under key statistics, some of the things you might think about, again, is market capitalization, maybe, concentrating on large caps or mid caps, maybe not so much on the small caps. But again, if you feel comfortable with that risk in terms of picking candidates, that's fine. Another one you could think about is, beta, right? This relationship to the stock to the S&P. And again, the greater the beta, the more volatility. Maybe somebody who has a limited amount of capital or doesn't feel comfortable with high volatility stocks, would look for, stocks that have a lower beta or a beta that's closer to, let's say, 1. Okay, so those are just kind of some ideas about selecting stocks in terms of, kind of finding ones that kind of fit our risk appetite. The second process we said is we're going to start thinking about from a top-down analysis. In other words, where I'm going to fish, what pond I'm going to fish in, and looking for those candidates that could have greater potential. So one of the things that we can do is we can kind of just look at the broader market and then look at our different sectors. Now for today, looks like each sector is down, and so is the S&P. But if we look, let's say, over the last 5 days, right, we can see which of the sectors have it performing, or at least performing better than the S&P in this case. If we look at over a 1 month period and a 3 month period, there is a theory that says that stocks that outperform for 1 month to 3 months will tend to outperform for 6 months, and those that outperform for about 6 months will outperform again for another 3 to maybe 6 months. So what I notice here is that consumer discretionaries is one of the ones that has outperformed over the last 3 months and over the last month. Now, what I could do from this point is just go into consumer discretionaries and start looking at those candidates that are inside of that sector ETF. But if I wanted to get a little bit more granular, right, I could go to, let's say, a major market heat map. And here, I'm in the consumer discretionaries. And this is where I can kind of do that analysis. Let's say if I go to a 3 month process, where this sector is up about 12% over the last 3 months. But inside of this sector, I could identify those stocks that have outperformed the sector. In other words, the ones that are leading that sector. And the one that jumps right out to us, our largest cap is, Amazon. But, you got Starbucks here. McDonald's maybe has not, it's right in that same, 12, close to that 12%. TJX companies, so here's Ford. So those would be some that you could look at. Now, again, if you wanted to even get more granular, we could say, well, let's say we've determined that consumer discretionary type stocks are leading the market sector. So what I could do is go to, for instance, the industrial heat map. And this is going, let's just I go into, here I'm on 1 month. I could look for those very finite consumer discretionaries. For instance, restaurants, right? That would definitely be a consumer discretionary industry. And look at those that have, a higher weighted alpha, or I could go into the performance and look at a performance on a monthly basis or a 3 months basis, and or look at year to date and my weighted alpha. And again, I'm just kind of looking here for discussion purposes later in the day. I do notice that McDonald's is one of the ones that's it's kind of always popping up on our selection. All right, but let's go back to sector and go to our discretionaries. All right, so let's do this. So we looked at choosing a sector that's leading or is outperforming the broader market. Now we've chosen that ETF or that sector. Again, I could be granular and look at the ETF that is for a very specific industry, or I can go inside of those ETFs, those are ones that are performing, to look for those outperformers that are in that outperforming. So it's kind of a top-down analysis and looking for those that are kind of carrying the market. So the next process we're going to do is we're going to do our multiple time frame analysis. And in order to do this, well, first we're going to start by choosing a higher time frame to define what I call this kind of field of probability, or kind of this playing field of price. So let me do this. Let's go back to our chart, and here I just picked Amazon because Amazon is one of the ones that is in our consumer discretionaries. So choosing a higher time frame is going to be up to the individual trader, and yes, you can choose a time frame that's different from what I'm going to demonstrate. It could be a lower, could be a higher, right? There's no right or wrong, right? I just want you to understand that there's a certain process. So I'm going to start at the weekly level as my higher time frame. Now, there are these trade-offs between how high you start or how low you start in terms of this higher time frame. But I will tell you this: big time frames, big money; small time frames, small money. But it might just come down to your trade plan and your risk tolerance. In other words, what you can afford. You might not be able to risk, let's say if I'm using a daily as my trend time frame, maybe you can't afford daily trend time frame risk. Maybe you have to go to a lower time frame. So that means that your higher time frame might come down a bit, right? But in this process, in terms of choosing our higher time frame, all I really want to do here is kind of look at the big picture, right? I'm going to look at where is my recent highs, where are my recent lows, and kind of maybe something like this. Maybe we'll go a little bit higher. We could do a little bit higher like that, and then do something like this. And again, I just really kind of want to find this playing field of price. So, what do I see here? Well, right now it looks like, we're kind of in the middle of this playing field, which means that when I start to do some of my market analysis in terms of my entries, I probably could go either way. I could look for breakout trades. I could look for pullback trades. If I'm at the higher end of this range, then I'm going to be a little bit more conservative. Maybe I'm going to look for pullback trades and maybe not breakout trades, because I could be bumping up against resistance. On the downside, when price is bottoming me, maybe I will be looking for more of those breakout type trades. So I really kind of wanted to see, where is this playing field of price? Where is my price in that range? In this case, right in the middle-ish. And then that big picture. Where is the path of least resistance? Or in other words, where is the market at risk? So again, looking at Amazon here, we're certainly bumping up against some potential supply or resistance currently. But above there, we could say, there's room for price to run and maybe even run to this, what looks like our high that was made back in March. On the downside here, again, could price fall all the way back down there? Yeah, I think that is a very small probability, but where is the risk in price to the downside? Well, certainly this gap. So, below here, there seems like a little bit more risk to the downside, and above here, risk to the upside, maybe into this range. Again, I just kind of want to feel out the market in terms of where price could go as it starts to move. So let's do this. I'm going to do, first, let me just kind of frame this out for us so that when we go down to our lower time frames, we kind of have some reference points. Because drawing on top of this little blue box can be a little bit difficult. So I'm going to just get rid of that. All right, so now I've kind of framed my playing field at my higher time, my higher time frame. There we go. All right. Oh, yeah, I was right. Yep. Okay. All right. So what do we see again? Kind of in the middle of the range, right? So the next thing we're going to do is we're going to drop down to an intermediate time frame to look at or discover our trend. Again, I started out of the weekly. I could go down to the daily. Now let me go back to the chart in a second. You could use a higher time frame as your daily, and when I do that, we'll see that you're probably going to discover there's not a lot of difference in it, but certainly in terms of price action, but maybe in terms of potential price area. So again, I'm going to drop down to my lower time frame here to do my trend analysis. And again, when we do our trend analysis, right, let's see, let's do this. Let me blow this back out a little bit. Right. Actually, I kind of want to give you those. Let's do this. Apologize. All right, so what do we see in terms of trend analysis? Well, again, how do we define trends? How do we define an uptrend? An uptrend is defined by a series of higher lows and higher highs. And then certainly this looks like the market is in an uptrend. So again, at this point now, I'm kind of in the middle of my playing field. I'm in an uptrend, right? And so the second process we're going to do inside of our identifying our trend is we're now going to locate those swing highs and swing lows. Now, what do I mean by that? Well, that's where price stops going down and starts going up, a swing low, and where price stopped going up and starts going down as our swing high. And then that also is going to help me kind of determine what type of trade that I'm going to take in terms of a drawback, which is where price pulls back from moving advancing, or a pullback is where price retraces after falling, or a breakout. So again, I'm kind of in this uptrend, right? Nice little uptrend. Where am I in my playing field? Or let's identify those recent swing highs, right? I think we could make a case that here's where price went up and then here's where price went down. Now, did price go up here and then go back down? Yeah, it could. So, we could lower this, or we could set this as a potential swing high too, right? I think this one might be more viable for us in terms of being more conservative and picking potential targets. And then on the downside, well, again, we kind of framed this out before on our big picture, but certainly here's our most recent low. So now we've defined, our range. We're kind of made it smaller, but now we have a, a range of probability at our trend time frame. And again, where do we fall in this process? Well, we're kind of in this analysis, we're kind of in the upper third, which makes me kind of feel like I want to look for more pullback type trades where price is going to fall and re-engage maybe our trend line or other technical analysis. For instance, one of the other technical analysis that a lot of times traders use are moving averages, right? And so when I look at this from a technical aspect of moving averages, and these are four different moving averages. I have a 200-day, I have a 100-day, a 50, and this red line here, which is right on our trend line that we drew, is a 20-day. So again, I would be more inclined to look for a pullback that re-engages a trend, where that trend can reinforce and push price higher. So right here on the 20-day, maybe I want to look for a pullback in somewheres in this area where we re-engage this current trend line and the 20-day moving average. But I also, down here, this gap, our 50-day is kind of right where that gap would be full. That would be definitely another potential area where we could look for an entry. Now, what I'm kind of assuming here is, I'm looking for, that trend to kind of price to kind of back off, and then, maybe what we would call a ABC pattern, and then see if we can hold, and then maybe, test these higher levels. Now, if price fell, let's say, to fill our gap, right? That would still be, a series of what? Higher lows. That would still be an uptrend, although this shorter term uptrend would have been, broken. But in our big picture, it would still be an uptrend. So again, depending on what price does, where one might find those opportunities. But for our discussion today, let's look at inside of this recent price history in terms of looking for a potential pullback trade. Now, the other thing we can do at this point in terms of our trend analysis, we can also look at other technical analysis. So I have a template called MACD and RSI. And what I'm doing here is I'm assessing my trend in terms of momentum. Now, what do I see here? Again, price is trending higher, and our momentum indicators are still moving higher. But what we have seen in recent days is, for instance, an RSI, is that as price was making a new high in this little trend movement, our RSI was actually falling. This is a negative divergence. If we look at our MACD, yeah, our momentum is still climbing, but it's slowing, right? Again, a bit of a negative divergence. So this, again, at this point, in terms of my trend analysis, is telling me that, yeah, I probably want to look for pullbacks and not breakaways, right? If I'm going to look for a breakaway, I probably want to see as these are turning positive or as they're accelerating. Or in this case, if we get back up to these highs that we've just recently made in the last day or two, I want to see these, turning back to the upper end of their range. Not seeing that, so that's again kind of pointing me towards a pullback scenario. Okay. So the next process we're going to do is we've decided we're going to look at, we're going to wait for a pullback, we're going to wait to re-engage our trend. So now we need to start assessing risk, and then we're going to set our rewards. So the first thing we're going to do is we're going to set our stop loss in our trend time frame. Now, why do we do that? Well, first of all, we're assessing the market from our trend time frame. So that's where we want to assess risk. Now, could I set my stop at a lower time frame? Yeah, I could, but I could be setting my stop in an area where price could pull back or break through and stop me out, and yet that trend could still continue. Plus, if I set my stop in the trend time frame, what I'm really doing here is I'm really deciding that where is that risk in terms of my trend. In other words, where am I wrong? Where do I have decided I need to get out, or this trend has potentially changed? But then what we're going to do is we will drop down to a lower time frame, and this is where we're going to start to reduce our risk. So we set our stop at the trend time frame, but we use a lower time frame to look for a cheaper, so to speak, entry. And then after we've done that, before we can even think about setting the target, we need to set our risk, is we're going to choose a realistic target. Now, again, each trader is going to be different. Each trader is going to have different philosophy of trading. But, maybe a day trader might be looking for 1-to-1s and 2-to-1s, and long-term investors might be looking for, maybe some greater risk-reward ratios. But for swing trading, I think the kind of the sweet spot we need to start assessing or evaluating trades is we want to set at least a minimum of getting 3-to-1 risk to reward. In other words, 1 unit of risk versus 3 units of reward. Now, how can I determine if that's when I set a trade up in terms of swing trade, how can I determine if the risk that I'm going to set up is realistic? And so a very conservative guideline here will be, I'm going to look at something called average true range, where I want to kind of capture this small portion of this price movement, somewhere between 1.5 and 2.5 times my average true range. Now, let's go back to our example with our Amazon. Well, let me just clean this up a little bit. All right. So here we are at the daily level, which was our trend time frame. So let's now drop down. Now, kind of a guideline for you on this is, you want to kind of use a 4-factor at least. So let's say if you're using, let's say you're going to do a smaller time frame analysis, maybe you're going to do 4 hours, then you would drop down to 1 hour, and then maybe 1 hour to 15 minutes, or daily to 4 hours, and then 4 hours to 1 hour, right? Weekly, daily, maybe 4 hours. But let's just look at a 1 hour chart for this assessment. Okay, so we said that we are going to define our risk in terms of our trend time frame, and we already did this in the big picture. We kind of said that, hey, where is the risk to price? If it fell into this gap, it could fall pretty far. And again, that trend line, remember our 20-day moving average and our trend line came in right around that value. So that's kind of where we're going to set our risk. So now looking at this in terms of where I might look for entries on a pullback at the smaller time frame, the 60-minute time frame, I do see a couple spots. Again, a lot of gaps in this particular stock. Here's a gap fill here, and there's a little gap here. Now, what I could do is, hey, let's say this is going to be my entry, and let me kind of round this off a little bit. And just for trading purposes here, let's just say 138 is our entry, and then our stop again below here. I think the number I was looking at this morning was around 165-ish, 160. Oops. And again, 138. Okay, so what are we risking here? Well, we're risking about $5.35, $5.40, right? And then we said that, hey, we're going to look at a risk-reward ratio of at least a 3-to-1 or better. If I look at my big picture, again, where did we define that upper end of our range? Well, looks like around 158.50, 158. So I'm going to go in here, and we have a little tool, risk-reward ratio. And so I'm going to enter at 138. I'm going to risk 132.65. And my target is going to be around 158. Okay, I always like to set my target just in front of an area of supply or an area of resistance. That way I feel like I have a greater potential of getting a fill instead of price inside of a zone in terms of a resistance zone or a target zone. And what is our risk reward ratio here? Well, we can see our risk reward ratio is 3.74. Is that above 3-to-1? Yeah, it is. Does this mean that this is a good risk reward ratio in terms of a trade? Yeah, it does. But now we need to ask the question, is this trade a swing trade? In other words, am I going to capture a small portion of a price movement in a short period of time? So how can I assess that? Well, there's a couple ways we can do that. The first way is, go back here, is under our technical analysis page, there is something called the average true range. Now, what does average true range mean? Well, it's a measurement of volatility, but it's also a measuring stick of a probability of price movement. Now, it's not directional. It's not saying that every day Amazon is going to go up $4.67 or go down by $5. It just means that the range of price on any given day with about an 85% confidence level is going to be around, $4.67. Now, the question I'm sure a lot of you are asking me is, well, John, there are several ATRs. Which ones I'm going to look at? I will let you know that when we look at more data, I'm going to show you that a little bit later, we do use the 20-day. As a swing trader, we maybe want to look at the 9-day. But what I'll do is I'll kind of look at both of them. And in this scenario, what do I see? Well, I see that my 9-day is less than my 20-day, which is kind of telling me that volatility is coming out of the stock and that the ranges are getting smaller, which means that I need to be a little bit more proactive and set my targets a little bit closer to current price. Now, if it was the other way around, again, I would be more on the conservative side and I would be looking at maybe the 20-day. But again, in terms of statistics and price, if I look at the 20-day versus the 9-day, yeah, I mean, it's about 10% in terms of price. But the rule we're going to use for risk is, and this is a rule of my preference, is I don't want to risk a whole ATR. I only want to risk maybe half of the ATR. Now, remember this trade we just set up. We set this trade up for a risk of $5.35. So that trade in alone is a greater than both the 20 and the 9-day ATR. which is telling me that I'm taking on a lot of risk to get this trade. Now, the second part of this process in terms of is this going to be a good swing trade is I'm going to kind of look over here to what the price of this market has been doing, let's say over the last week, 5 days, or over the last 20 days. Now, we already discovered that Amazon has kind of pulled back in recent days. It's kind of in the range. But if we look at our 20-day, right, and the trend that we're not analyzing in the last month, Amazon increased by $18.3. So if I think about that, if I divide that by, 4 or 5, then I'm getting, closer to maybe $4.50, somewhere between $4 to $5. In terms of how much this price action in this trend has fallen over, let's say, 5 days, or the last 4 days, or the last 3 days. So, and again, in that sense, right, that might be the target I'm going to look for, right? A variable of how much price has moved. And so what did we say in our analysis is, well, we want to be conservative and we only want to use about 1.5 to 2.5 times our ATR. Again, if I look at 1.5 and 2.5 times my ATR in this case, so what are we looking at? Well, we're looking at around $6, maybe $7 for a potential target. And if I only want to risk half the ATR, right, in this case, $2.50 or $2.30, right, a risk reward ratio of 3 to 1 puts me in around $6.75 to about $7. So now what is happening is that my trade is lining up with the reality or the statistics or the data of the price movement of the trend that I'm analyzing. So let's go back to our trade. And this risk of $5 we determine is too much. And that target is probably too far away for a swing trade. Not that that price can't get there, but it certainly is too far away in terms of what we've just analyzed. So where do we need to be? So we said we want to try to risk around, under $2.50 or maybe around $2. And notice that if I bring down that entry, that puts us kind of right in this gap, right? So that would be the better swing trade in terms of a pullback because it has a greater potential in terms of less risk, and if we do get to that 158, a much greater reward. But also let's think about that realistic target. So here I'm only risking about $2 in this trade, which means that I can set a target, a very realistic target, at around $6. So $6 from 134.77 puts me around 140.77. And that would put my target right here. And so price hasn't even gotten there yet, right? So we haven't even gotten below there. And there certainly could be a lot of room to increase that profitability if price comes down, again, kind of like our ABC, which we're anticipating, comes down, gives me that entry, and then comes back and tests that most recent high, right? And that would give me a greater risk reward ratio, all right? So that's kind of the swing process in terms of risk assessment and also in terms of setting more realistic targets using our ATR. Now, options traders, at this point, if you felt that there was an ABC wave, or you felt that this drawback was a better setup, let's say at that 138 level. So what are some of the things that you could do? Wait for price to come back into that level. And at that point, what you could do is you could execute some type of bullish option strategies. Buy calls, buy call spreads, vertical spreads, some debt spreads. Maybe you buy the 138s and you sell this little high right here, the 146s, 147s, or you buy the 138s and you sell the 158s, right? The other thing is, if you believe that this trend is in control and your other technical analysis is lining up, and what could we do? Well, let's pretend that price never gets down to this entry, right? Well, options traders, right, we do have that benefit of taking a trade that price doesn't come to us. Let's say it comes down to this level here and never gives us that entry. We could be sitting around waiting for that. But in an options trade, what could we do? Well, maybe we sell a put, and we sell a put down here, a 135 put. And if price breaks below my risk, in other words, the stock price breaks below it, then I would get out of that put trade, right? And again, there are bullish put trades in options, right? So you could do that as a process as well. So options traders, there's still other ways we can still take these trades, even though the outright trade doesn't work out in terms of the math and the numbers in terms of our price probabilities as we related to our ATR. Okay. All right, so let's do this. So we set our risk at our trend time frame. We used a lower time frame to look for structure, to look for a potential entry. Now, let's walk through another example. And when I was doing this morning, I was looking under the discretionaries. I did notice that, again, I said to you that McDonald's was one of the ones that was kind of popping up on, as I was doing that top-down analysis, was popping up in my list. So let's go through the same process. So let's start at our weekly. And I kind of took the liberty here to just, make for a better time for us. Right, so, what's our playing field of probability? Well, here's our high, here's our low, and where are we at? Well, in terms of our trend, in terms of price, we're at the very high end of this range. Again, if I'm in the high end of the range, I'm probably going to look for more pullback trades than breakout trades. Not that I can't find a breakout trade, but the next breakout trade that I might be looking for is when price is way up here as we break above this, what looks like an all-time high. So I've defined my playing field, and I've discovered that I'm high in this range and that I'm probably going to look for pullback trades. I'm going to do my trend analysis. Again, what is our trend? Very easy to decipher this one, a series of higher highs and higher lows. So we're in an uptrend. Again, if I went to, some moving averages, right? All my moving averages are turned up. Again, could I wait for a pullback all the way to these moving averages and still be in an uptrend? Yes, I could. If I wanted to capture this kind of momentum that this trade is under right now, this market is under, maybe I look for a pullback in this kind of this area. All right. So now I'm going to step down to my lower time frame. And what I've done here is we're going to walk back in time, and I'm just going to kind of walk you through this process. Is these blue boxes I'm going to show you in the lower time frame are going to be what we would call pullback trades. The purple boxes will be breakout trades, okay? So let's go into the past, and one of the things that I want to give you in terms of a trader's insight is determining values or areas or zones, however you want to define it, in terms of what would be a higher quality area where I want to enter into the market. One of the things I like to find is these two probabilities. First is I want to see an impulse. In other words, a big green candle. If you're just looking at regular candles, a white candle. I want to see that impulse. And I like to find areas that are the origins of these inputs or the beginnings of these inputs. The other thing that I like to find is that these green candles occur at a very specific time of day. Notice that this green candle occurred at 3 p.m. 9 o'clock on my chart here is set at Chicago time. So this was at the end of the day, and this candle was at 9 o'clock at the beginning of the day. So I like to find zones of these impulses that come at the openings and closes of a market. That's where the market, I feel, is more out of balance, and there's probably a greater probability of finding good entries. Now notice on this box here, again, this is at 11 o'clock in the morning. Again, that first couple hours is okay for me, right? And the last couple hours are okay for me, right? I like to see that as long as we get that impulse candle. All right. So what did we say? We already had designed this trade. We were saying that we were high in our playing field, and then we want to look for more pullback type trades. Now let me just do something here. I just want to make sure. Yeah, okay. So this is set. All right. So this was. I think this has to go up there like that. Yeah. Okay. Okay. All right. So the other thing we said we want to look at in our determining our risk assessment is we're going to look into our more data tab. Again, right click, technical analysis, and again, our average true range. And we can see our 20-day average true range for McDonald's is around $4.16. So we want to kind of risk around $2. All right. All right, so let's go back to this trade. And, I look at this zone, and the top of the zone is around 250.35, and the lower of the zone is 248.63. So is that $2 or less? Yeah, it is. So that would be a good zone for me in terms of a potential entry. Is this one a good zone? Well, it's right on that cusp of $2. Again, a better entry. All right, so what does price do? Well, price shoots away, gets close to that higher time frame resistance, that target, and then price does what? Comes back into my zone. Again, a pullback. So would this trade be a good trade in terms of a swing trade? Again, trying to capture a smaller portion. I'm kind of risking $2 here, to make, try to make $6. Am I going to get that? It doesn't look like that at this moment. Now, what could happen is price could fall deeper in the zone where I risk only, let's say, $1 or $1.50, and then this target might be doable, right? But what does price do? Kind of meanders, then it does reach that target. Now, at this point, what we could talk about is we're now up against an area of resistance, which might be a potential breakout trade, right? And so how do I define a breakout trade? Well, I want to see price get above an area of resistance or a most recent high. And you can see it came up here and tested that. And that's kind of telling me we're getting poised to break out. And so our risk would be the lowest candle from that point forward, in this case right there. Again, right around $2, which fits right into our risk scenario. And then I need to wait for price to break above, right? Again, close above. And again, in this term, in this trade, I'm risking $2. I want to try to make $6. Well, is my next target is $6 away. So would this be a better swing trade? Yeah, it would, because it has a greater risk reward ratio. And then what does price do? Well, it runs right up there, and it actually just touches our target. Again, one of the things I want to emphasize to you is, being a little bit more conservative about your targets and setting them in front of some of these significant levels. Okay, price comes back, right? Falls back, touches our zone again, but would we take this as a pullback? Probably not, because that risk is not, reward is not there. Here, price falls back into that pullback zone that we originally set, right? But now, right, my risk still $2, and that target now, right, that one that eliminated me from taking the trade the first time, that one is gone, but there's that new target. And does that give me a good risk reward ratio? Yeah, I'm risking $2 to make about $9. And so that would be a good trade. Okay. And then again, maybe a potential breakout trade, but price did not break above this recent high, right? It's kind of setting up. So I'm waiting to see what happens. We get the breakout. Now, how could I take this trade? Well, I could risk this candle, right? All the way back to this point here, right? Too much risk, right? Too much risk in this trade based on that near-term target, right? We're probably risking $3 or $4 to make only about $3. Not a good trade. So we'll wait. Price goes sideways, comes back into our pullback zone. That's what we're looking for. We're looking for pullback trades, right? And then price gives us that target. Okay, and then now we're up against that high, right? And could this become a new breakout trade? Yes, it could, right? What's my risk? In this case, looks like I'm only risking, about $1.50, well inside of my $2 that I want. So definitely a trade I'd be looking for. I'm just waiting for price to break out, right? And price is now broke out. I'm risking $1.50, so I probably want to get, $4.50. It's probably around 270. Again, kind of in front of my higher time frame target. So, kind of in this trade, we're waiting to see what happens, right? Our target in this case would be around 270. Okay, so, I kind of went through a lot of this kind of quickly. Just remember that all of our sessions are recorded. This is the process we're going to do. So what I want to do here is, I do see there are a couple questions. Let me answer those couple questions, and we'll do a takeaway. Any questions that are kind of common, Jean?
Well, John, I've sent over all the questions to you. Why don't you take a moment and look through those? And while you do, I'm just going to mention to everybody out there that, we've been watching John draw trend lines and rectangles and the reward risk tool on his charts. If you have a bar chart account, whether it's one of our free accounts or our premier accounts, I just want to remind you that we save all of those drawings on your individual charts, so you can kind of follow along with John's teachings here and start marking up your own charts as well. If you are not a Premier member, and if you haven't tried Premier, we do suggest that you take a 30-day trial. There's absolutely no obligation, and I think you're going to find that the features and tools that you have in a Premier membership will really benefit you. So back to you, John.
Thanks, Jean. All right, so Aaron asked something about liquidity and our bid asks, right? Again, Aaron, the more volume that a market trades on a daily basis, it's just going to tighten up that bid ask. It's going to increase that liquidity. Is it less liquidity or more liquidity a good indicator of a candidate in terms of price action? Not necessarily, right? Maybe even less liquidity, you might get more volatile price movements. I think that's kind of the question you're asking. So Nara asks, when looking at 3 months to 6 months performance, doesn't this mean that the stock has already climbed up significantly and a bit too late to take a position? Well, again, there is a relative strength theory that says that stocks that outperform for a month to 3 months tend to outperform for the next 3 months. Stocks that outperform for 6 months could outperform for the next 3 to 6 months. Is there a potential for that to happen? Yes, there is. That's why we need to also do our trend analysis, right? That's why we need to look at that playing field of probability. If my market has been in a 3-month uptrend and now we're at that high end of that high time frame range, then the probability says what, Nara? That, yeah, that might be too extended. But if there's room for it to run, or if it's making all-time highs and there's no ceiling in front of it, could that stock continue to outperform? And the answer is, in a probability sense, yes. So don't get caught up on that you might be too late to the game. As long as you use good risk management, you should remember, we're not trying to catch a big piece. We're only trying to catch like the next 2 to 3 days, maybe the next week or so, all right? Gina asks about gap theory, and that gap theory says that all gaps want to be filled. And so, Gina, yeah, I do like to look for pullback entries on gaps. But there's also another part of gap theory says that, especially on breakaway gaps or runaway gaps, that price tends not to pull back in the initial impulse. So you can do both. You could take a breakout trade on a gap breakout impulse and then wait for that pullback on that gap fill. So a lot of times, in certain gaps, especially those that come from, big impulses or in, very strong trends, you can get 2 trades out of the gap, right? Rick recommends that if you look at price, volume at price is a good indication of supply and demand, and I would agree with you with that, okay? A question here about how far back should we go in time in terms of doing our price analysis. So there is a discount the farther you go back, but again, if I'm looking in a 3-month or 6-month period, I should be able to find significant swing highs and swing lows. So I don't think you need to go too far back. Again, if you look back 2 years or 3 years until you find a really good, level, then that would be discounted a little bit, right? So, it's a give and take at that point. But you should be able to find significant swing highs, significant swing lows, especially at our higher time frame and our trend time frame within the last, month or 3 months or so. Okay. So Brett asks about using the Fibonacci in terms of pullback trades. Yeah, that's a great tool, Brett. If you know how to use that, from a most recent high and a recent low, and you want to look at one of those entries. And again, this is kind of that theory of technical analysis, this cluster of evidence. If your entry and your risk that you can tolerate is at a 38% retracement or 62% retracement, they kind of line up, and then they also line up with a trend line, or they, line up where your MACD is starting to turn positive, or, vice versa. Yeah, then that would be a great tool. Okay. All right. I'm gone a little bit over here. I do see a lot of other questions. I'm sorry I didn't get to them. Just make sure if you want your question answered, just send it to support@barchart.com, and we will get to that question for you. All right, Gene. So let's do this. Let's sum up real quick. All right, swing trading is a strategy that attempts to capture small portions of a trend. Again, that thought of is it already too far? Has it already gone too far? Remember, we're only trying to capture a little piece of it, right? Choosing the right market that fits our risk tolerance. We talked about this in terms of volume and price and market cap and beta, but also, that other part where, do I want to trade, high tech stocks or, high beta stocks, all right? Know your playing field of probability, right? So a lot of swing traders are going to be trading, some of them are going to be trading in these lower time frames, maybe these intraday time frames, hourlies, 4 hours, 1 hour, 15 minutes, right? And what happens is they get too involved in these lower time frames. And they don't take that moment to step back and look at the big picture, right? One of the recommendations I would make in terms of swing trading is at some point, I want daily to be one of my time frames. In other words, at least my highest time frame or maybe my trend time frame, just so that I can look at that big picture, right? What I don't want to do is be looking for pullbacks and breakout trades as we're coming into a weekly area of supply or weekly area of resistance, right? I want to wait for a greater pullback, look for a better opportunity. Again, that will also play out in our risk reward ratios. Identifying your trend, importance of this, right? Trend's your friend. We're going to go with the price movement, but also where is our trend in that playing field of probability, which is going to help us determine the type of entry, right? If I'm in the middle, I could go either way. If I'm at the high end, probably going to look for pullbacks. If I'm at the low end, probably looking for breakout opportunities. Setting our risk in our trend time frame, right? That's the time frame we're trying to capture the piece of price movement. So that's where we're going to set our risk. But once we set that risk, we can reduce that risk by using lower time frames for entries. Again, one of the things I like to look for is at lower time frames, find those zones, those entries that coincide or coincidental with, the openings and the closings of our market. And finally, setting those realistic targets, right? Making sure that that target is reachable or probable. And the rule that we gave was, again, just kind of a trader's rule of thumb, is 1.5 to 2.5 times our ATR. Could we get greater rewards? Could we set a higher target? Yeah, we sure could. But if my market gives me 2 ATRs and I've used the half ATR as my risk rule, at that point, I'm definitely going to do some kind of risk management. Doesn't mean I have to get out of the trade, right? We want to let our profits run, but I'm going to do some kind of risk management. And we do have a couple of sessions about proper exit strategies. One of them one's in our archives, but a technical trailing stop or a trailing stop, raising your stop to make sure you lock in at least some profits after the market has rewarded you. Okay, all right. So let's do this. Upcoming webinars. Let's talk about what's on our agenda. And whoops, there's something new here, Jean. Do you want to talk about this?
Sure, John. You will see an announcement at the top of our webinar page here. John is starting a new series on Fridays. These are really tailored for our Bar Chart Premier members. And for the first 2 sessions, we are opening up these little mini sessions for everybody. So we call it Market on Close. John's going to do another live session Friday. They run at 2:30 p.m. Central Time, 3:30 Eastern, just 30 minutes before the close of the bell, which is where we get Market on Close. And John's going to go through and review the week's highlights, lowlights. He'll talk about some interesting trades that he maybe saw happen during the week, and we'll leave a good amount of time to answer Premier user questions at the very end. So if you're interested to see what this new session is, please sign up. Everybody can reserve a spot for the next 2 sessions. After that, you'll need to be a Premier member to hear from John on Fridays and get his insights. Besides that, go ahead. I'm sorry. Go ahead.
I was going to say, we're really excited about this. I think it's a great way to give back to our Premier members, but also it's going to allow me to be a little bit more of the trader instead of the educator that we get in the webinar, and help you guys kind of connect the dots in terms of looking at the big picture, the macro environment, and then also doing our technical analysis in terms of trends and trades and things like that. So I'm really looking forward to it. I know Gene and the team has been really hard and working hard and supporting me. So I really encourage you guys to come and check it out and see what you think. And it's going to be evolving. It's going to be fun. And I think it's going to be really cool too. All right. So in terms of where we're at for next week, in terms of our regular scheduled webinars, we're going to look at unusual options volume, how that can play a role in our trading. Maybe kind of give us an idea of the breadth of the market or the sentiment of the market. Also looking how to break down unusual volume to look for trading opportunities inside of our options markets. Okay, so I think that one will be a fun session as well. All right. Until next time, I want to wish everybody the best of health. Stay safe out there, and the good of all trading.